Welcome back to another episode of the Dealmaking with Laura DiFrancesco podcast. I'm so excited to be nice and comfy cozy here with you, chatting about what are actually deal makers in due diligence in an M&A transaction. We have a lot to unpack here. I'm excited to dive into it in greater detail. If you haven't already checked out our prior episode on due diligence, I think it's episode 6 of our podcast. I highly recommend starting there. I really go over the basics of due diligence, understanding the different types of due diligence. Here, we're going to be narrowly focused on what are the deal breakers that I see happen all the time in deals. Not all the time, they are rare, but what are the deal breakers that I do see happen in deals, and what do we do about them? How can we navigate them? How can we address them? So this is going to be a really narrow focus. If you're looking for buy-side due diligence preparations, go start with episode 6, come back here. We're going to be talking about the deal breakers, really the make or break moments in a deal. What is going to tank it? What is going to sink it? We're going to be debunking some major myths here because I hear so many myths about deal breakers in M&A, and we're here to debunk them. I do want to give you a bit of a thank you for everybody's patience. I was in a car accident a couple months ago. So we do want to continue moving forward with weekly episodes. So be sure to subscribe for more all about deal making, mergers and acquisitions, buying and selling businesses here at Dealmaking with Laura DiFrancesco, now that we are back in the swing of things. So thank you everybody for subscribing, supporting, sharing our podcast. You can follow us on all the social medias. If you'd like to work with us at Dean Street Law, be sure to reach out to us. All the information in the show notes. So first off, before we get started, why are the deal breakers important? Because not only will it make or break a transaction, it could make or break your business and career. And that is why we don't take them lightly, because it's the moments that sink the ship, and they're really, really hard to come back from. They're not saying that we can't do something about them. If we find out about them, we can navigate them, we can assess the risk, allocate it appropriately. But if you don't know about it, if you rush through the process, if you spend millions of dollars on a transaction that ends up being a dud, it will likely hurt and be very painful. And I always love learning about lessons in life that I don't want to go through myself. So I encourage you to tune into this episode to learn more about how you can identify and mitigate deal breaker risks in your deal so that you can be successful at the end of the day. Because I think the goal for everybody is to make money and not lose money. I know it's my goal in life and my goal for all of my businesses. So I'm here to support you in that endeavor for sure. Especially in the entrepreneurship through acquisition space, it's especially important because folks that are new to the entrepreneurship through acquisition space might not have as much experience in deal making, and they also might not have the reserves. When you're talking about private equity, they have a portfolio of diversified assets investing in deals. And so if there's if there's an issue, they have the rest of their portfolio to balance out that issue and to safeguard against that risk. And they're also working with other people's money. A lot of time in ETA, you are working with your money, investors' money that you know closely. Obviously, you always want to be a good fiduciary no matter what in private equity or in ETA, but just realistically, it is going to be painful, not to other people, not on the whole, and be okay. It's going to be very painful for you specifically, your wallet. So that's why it's really important, especially in any transaction, but especially in ETA. Those are your dollars at risk, and it becomes even more important to know what you're doing and to have good representation like Dean Street Law there to support you through the process. So let's debunk the biggest myth that I have ever heard in deal making that I hear way too often. You see it on platforms, people making comments, lawyers kill deals. Yes, there may be some very bad lawyers that kill deals, but let's be real. That's not the reason the deals are dying. The reason the deals are dying is because sometimes the deal is not the right deal and it shouldn't be going forward in the first place. That does mean that you as the buyer have to be doing your due diligence early, in a sequential order, appropriate to your level of risk and tolerance and timing. All of that we talk about in the first episode 6 on due diligence. So, it's your responsibility to do due diligence sequentially, because these are risks that you should know about from the beginning. And these are risks that you should be thinking about and investigating early on as the buyer. This is a buy side type of conversation. We are going to be doing an upcoming episode, sell side, on what sellers should be doing as due diligence, because there are deal breakers for sellers as well. And there are deal breakers and due diligence that sellers need to do also in a transaction. That's normal, expected. It is a two-way transaction, two parties contracting together, most of the time for years in some sort of seller note or something. So there does need to be a lot of trust established and good due diligence that is done for that process. So with respect to deal breakers, I don't know that I've seen the lawyers ever kill a deal, but I do see many other deal breakers kill a deal. And deal breakers aren't prevalent. It's not necessarily it's a small percentage of deals where I see this happen, and it's typically before it gets to legal due diligence. So these things are happening and it's dying because it's not the right deal. It's not a good fit, and there are major systemic issues. And if there are risks that the lawyer uncovers, that's because they're doing their job, because you want them to uncover really bad gating issues before you dive into negotiating the transaction documents and spend money on the purchase agreement and all of that. Because if these are the issues that you're coming across, then you really shouldn't be doing the deal in the first place. And it's better to spend a couple $1,000s on due diligence than to spend a couple $1 million on a deal that doesn't work. So I don't see lawyers being the biggest deal killers out there. I do see financial issues and person-to-person issues being the greatest deal breakers out there. So let's get into those specifically. And some of them are not legal issues. But let me tell you, when you're working on the deal and you're one of the biggest advisors on the deal, you tend to be the person that a lot of folks talk to about these types of issues, whether or not they're legal issues. So I'm very grateful for my clients. I love being an advisor on these transactions. I love telling them what I've seen before, how we can mitigate these risks. And you should be talking to your lawyer about non-legal risks too, because there are a lot of ways that you can mitigate them. But there's going to be a couple things that you just can't mitigate, and things where you just shouldn't do the deal. And those are bad actors and fraud. And it's sad, but they do happen. So one of the things that we include in all of our letters of intent, and if you purchase Acquisition Insights, which is our course on buying a small business, over 80 lessons on the various aspects of buying a small business. There's also our templates as well, including our stock purchase or membership interest purchase and asset purchase templates for letters of intent. All of them include a provision that says that the seller does represent that the financials provided are accurate representation of the financial health. They're true and correct and accurate. Now, certain sellers might not want to particularly represent and warrant exactly to that. They may say, well, my financial accountant prepares it. I don't know specifically. So then you might add a materiality, or you might negotiate it in some way. But a seller should be able to say that their financial statements are an accurate portrayal of the business, that they are true, correct, and accurate, and they're not omitting material facts. We have encountered deals where upon financial due diligence, and so this was early on in the transaction, the buyer did realize that the financial statements were not accurate, to the point that they might have even been fraudulent, to the tune of like $100,000 on like $1 million deal, that they were off. And there was material differences between, and this is not due diligence of financials, of saying like, we don't agree with your add backs, or we think that you're characterizing expenses slightly differently than they should be, something like that. We're not talking about that. We're talking about the seller's own financials don't add up. They're materially off by hundreds of thousands of dollars. And so that's an issue that might be even a fraudulent issue, because how can you not know that your finances are off by like $100,000 all over the place? Like $60,000 here, $40,000 here, $50,000 here. That's pretty bad. So I do include that in letters of intent. It depends on how highly negotiated, how competitive a situation is. But if a buyer is cost sensitive and wants to be more aggressive in their letter of intent, or they want to include a provision to protect them in the event that the financials are wrong, and not wrong in the I disagree with your add backs, but wrong in that they are blatantly false, then you could have a provision in your letter of intent whereby the seller, if their financial statements are off by a material amount, not in the add back aspects, but in the financial reporting aspects, then there would be a reimbursement of the buyer's costs. That is going to be hard to negotiate, especially in a competitive situation. But if you're conservative and that's the line that you want to draw in the sand, then ask for it. You can only get what you ask for. So yes, that is one of the biggest deal killers, is fraudulent, misrepresented financial statements. And that is why you typically prioritize financial due diligence prior to legal due diligence. The other is, of course, disagreeing as to the add backs, etc. So doing financial due diligence, or if there's been a downturn in the business since the initial financial statements were provided. So you always want to ask for updated year-to-dates, updated financial statements. That is a gating item. And especially if you're cost sensitive and you don't want to spend money on legal due diligence, and you can negotiate the time, because remember, it's all a part of the timeline. You can't be both cost sensitive and timeline sensitive and want both. That's going to be extremely dangerous territory, because you do need the appropriate amount of due diligence no matter what your transaction is. So you do need to make sure that the work that you're doing is going to be sequential to mitigate your risk to the greatest extent possible, provided that you've built in the time. So if you have a 90-day, transaction timeline, we've talked about this in the episode on transaction timelines, but if you have a 90-day transaction timeline, you're going to want to spend no more than 30 days on financial and getting started on legal due diligence, because you do need at least a month to be negotiating purchase agreement and transaction documents, and you do need time for that to also happen pre-closing, get all of the bank stuff ready for closing, etc. So you definitely want to make sure that you're getting started on legal due diligence. I would say you should complete your legal due diligence in the first 30% of the transaction, and start it no later than the first 30% of the transaction timeline, because if you don't, you are not closing in that timeline. I think it's very hard unless you have all parties agreeing that they are going to work judiciously to close quickly. So the next item after financial due diligence is one of the greatest make or break moments. Now, there are ways that we can come back from it. If it is not fraudulent financial statements, if it's not falsified financial statements, which should be telling you that maybe you shouldn't trust any of the other information being provided by the seller. If it is merely a disagreement about the value of the business, there's plenty of ways to come back from that. There's a earnout or a reverse earnout, which is essentially a forgivable seller note. And there's also ways that you can have it where if the seller wants a second bite at the apple, they could do retained or rollover equity. And then if the business increases in value while they stay a part of it, then they get a second bite at the apple. So there's so many different ways to address that. Those are just, we're not kind of going to spend too much time on each of them. I just want to go over the big items quickly, and we have plenty of solutions. So if you come into those issues, do talk to your attorney about them, because there's plenty that your attorney can do to help you navigate those situations. And most of the time, the seller will also want to find a solution if there's been a downturn in the financials or something of that nature. Most of the time, the seller is going to realize that if they just put it on the market, the same thing is going to be determined by every buyer. And so there are adjustments that are going to need to be made. Now, as I said in the first episode on due diligence, episode 6, I believe, it is expected that it's confirmatory due diligence and not that you are expecting to negotiate down regardless of what the findings are. So it is expectation that we're all operating in good faith. This is confirmatory due diligence, not saying, well, I'm going to offer this, but then know that once I do due diligence, I'm going to come in at this number. That's not, you're a bad actor in that sense. In that situation, bad karma, not a way to do deals. It's a small space, and believe me, those things don't work out well in the end. Now, aside from financial, what else is there? The bad actor aspect. And I think a lot of people don't take this seriously enough. And it doesn't have to necessarily be a fraudulent bad actor to not be a good deal. Realistically, most buyers and sellers are working together post-closing. If you don't like working with them, and if you don't like them, and you can't get through hard times together, it is probably not a deal that you want to do. If you don't have confidence in them, if you don't believe them, if there's not trust, that's not a deal you want to do. And sometimes people really push the envelope, getting pretty far into a deal before they decide that the person that they are dancing with is not the person they want to dance with. And while business transactions are different than personal relationships, I do think when you're thinking about marrying someone and you're thinking about getting in a relationship with someone, you don't focus on how good your prenuptial agreement is. Yes, that may be important, but you focus on, do I want to be in this relationship to begin with? And then if something happens, how can my prenuptial agreement help me or support me? But I have had people talk to me and say, well, I don't believe them. I don't trust them. Is the contract going to cover me? Well, yes, you can make a contract say something, but then you have to go through the process of enforcing it, and that's not pretty. You have to go through litigation. You have to get a judgment in favor of you. Then they have to actually perform in accordance with that judgment, and that's a disaster. Know who you're dancing with and decide that that person is the right person to dance with, and then have backup that supports you with contracts and insurance. But if it's not the right person and the structure is not correct, having support from contracts and insurance or whatever, depends on the situation, whether insurance would even be applicable. But if you don't have the fundamentals, you don't have a foundation for a successful transaction. And I hate to be the one to break it to you, but you should really decide that pretty early on. You should really get to know the person that you're doing business with pretty early on. And if you don't trust them, and if you don't think that they're telling you the truth, and if you think that you have to lean on a particular provision, such as indemnification or representation and warranty, if you are planning to rely on that, you're probably not in the best place. The contract is there to support you, but it can't do the heavy lifting of making sure that you're doing business with someone who is good to do business with. Unlock the power of in-house legal expertise at a fraction of the cost with Legal Foundations. Gain immediate access to a comprehensive legal crash course for business, a rich library of on-demand video legal support, and the opportunity to apply for group consulting with Laura DiFrancesco as your legal mentor. Whether you're starting up or scaling your business, Legal Foundations has everything you need instantly available. Join now and position your business for success. Visit lauradifrancesco.co/the-shop for more information. Just making sure that we don't have a fire all over the place behind us. It's nice and warm and toasty though. Alrighty, so we've talked about financial due diligence and personal due diligence. Those are both important things. I think there's also a lot of red flags that you see that may not be necessarily deal breakers, but they are going to start to give you some information. If there's litigation, if there's claims, if there's employee complaints, and this is all stuff that we request during the due diligence process, but you can request and ask before you engage lawyers, has there been any litigation? If there has been, what's the issue? And I'm not saying that if there's been litigation that they're not a good person, but if there's a pattern, if there's something that you can glean from that, if there's open litigation or open issues, then those need to be addressed. And you have to determine, is this a pattern? Is this an issue? Is this an issue with the person or the business that may come back to haunt me? Indemnification is there to protect you, but you shouldn't just charge forward knowing that there's issues and then expect it to all work out. Because remember, unless you have actual mechanisms, and this is something that we do very well and that we focus on at Dean Street Law, clearly, unless you have mechanisms to actually have solutions and resolutions for issues such as indemnifications, such as clawback provisions or set-off provisions in a seller note or an indemnity escrow or something like that, having to sue someone to enforce an indemnification provision is going to cost a lot. And yes, you may have the right to recover, but that's not just cost of money. We're talking time, energy, business resources. You can spend all of those on growth and getting your business where you want to be, or trying to recover against something that you knew blatantly going into it was an issue, but didn't adequately cover your bases for it. So let's talk about how you can cover your bases for it. Ongoing litigation, that's risky. That is dicey. And unless you know what the claims can be and there are no additional claims such as loss and suffering and special damages and everything for malintent or something like that, there's tons of special damages that can go beyond actual damages in litigation. Unless you know that it's limited to those actual damages and what those actual damages are and what the claim is, you're really in some hot water if there's open litigation. So yes, open litigation may be a reason that it's not worthwhile getting into, because litigation at times can sink the ship. Now, if there is enough knowledge about the claim, about the issue, and you know what the potential for liability is, that is where I always recommend having an indemnity escrow to have, or even beyond your indemnity escrow. So there's so many different solutions that you can have here. One of them would be having an escrow account related to those, and so having the funds for the total amount of the claim be put into an escrow account, and then once that claim is decided, then the amount paid to the claim goes to the claimant, and the remainder goes probably back to the seller. So that is one way to fix it. Another way is you have an overall indemnity escrow, which means that you hold back a portion of the purchase price from being dispersed at closing, and you hold it in escrow for a certain period of time, maybe a couple months, maybe 6 months, 12 months, sometimes longer, depending on the claim, what's known, what's unknown. And you have that in place so that if something comes against the indemnity, you have a place to go to for recovery immediately without going to litigation and needing to enforce that. Other ways to support it is clawback agreements, clawback provisions and set-off provisions for seller notes or other obligations. If the seller owns real estate and it's going to be leased to the company post-closing, you could also do the same thing for your lease payments as well. So depending on your value of the seller note, depending on the value of any other financial obligations that the buyer may have to the seller, earnouts in non-SBA loans or non-SBA supported transactions, or anything else that may be paid to the seller. you can credit what the seller would owe you for that indemnification that they would be responsible for against what you would owe them under the seller note or a lease or something else. So you can use all of those, and there are other tools as well. You can use all of those to be able to address issues. But you really, really have to be careful when you're talking about ongoing litigation that's open litigation, because that can really be a tremendous issue. Thinking about buying a business? Unlock the secrets of successful acquisitions with Acquisition Insights, your legal roadmap for success. With over 81 modules of video lectures, written materials, guides, and checklists, we provide in-depth guidance to navigate every step of the process. From initial interest to closing the deal, get the expertise you need to make informed decisions. You can also access our battle-tested templates in the Acquisition Insights course and templates bundle, including letters of intent, pre-LOI and post-LOI due diligence request lists, material deal terms lists, and more. Visit lauradifrancesco.co/the-shop today and take the first step towards buying your dream business. So the last item that I'll say with respect to deal breakers is unsolvable cultural misalignment. I think a lot of people try to say, well, I'm going to work on this business and I'm just going to fix the culture from the inside out. Now, most sellers are not going to want a buyer to go in and announce that they're buying the business prior to closing. So how do you figure out culture? A lot of it is seeing the business and talking to the seller on a regular basis prior to closing of what issues are coming up. What's the culture like? What's the expectations? Does anyone come in late? Like what's the vibe here? And so you have to make sure that the culture that they have is going to be something that you can adopt. And you also want to see, is there a way to do a site visit off hours or something like that? Or are there key personnels that you can speak with after maybe the purchase agreement has been delivered or something reasonable? Are there a few people you can speak to after a certain amount of due diligence has been done? Maybe the purchase agreement is provided, or maybe even the purchase agreement is signed, but before closing. So you do want to be able to be flexible and understanding, but also know that there's a certain amount of information you need, and cultural misalignment can be a key issue. It is very difficult to tell prior to closing. It is difficult to tell even in due diligence. It's really about being observant, asking good questions, being the key person in driving your own success here. But that is very important. Now, there are other smaller due diligence matters that we can find during due diligence that are going to simply influence the drafting of the documents. For instance, sometimes sellers put a lot of personal expenses through the business. That's pretty normal. Every single business is going to have some sort of issue. That's okay. But it may mean that we would want to negotiate for longer tax indemnification. So if the IRS says, hey, this is a personal expense, not a business expense, we make it clear that the seller would be responsible for that. Now, most parties have a pretty good understanding that if it happened pre-closing, most likely the seller should be responsible. If it happened post-closing, most likely the buyer should be responsible. So when you have two fair people negotiating indemnification provisions, durations, etc., you usually end up somewhere pretty fair. But there are cases where either due to opposing counsel or due to the seller's positioning, they don't want to be responsible for something that happened pre-closing, even if they really should be responsible. So then you have to make a judgment call as to how big of a risk it is. Is it something 7 years ago, but then they cleaned up their act last year, or cleaned up their act 3 years ago, whatever the case may be. But there are certain risks that really should be the seller's risks and that do need to be addressed in carve-outs or specific explicit language within the indemnification provisions. And we do make that clear. So if the seller did something specifically that they know might have been an issue, so sometimes sellers don't have the appropriate registrations to do business in certain states, even though they should have. Maybe they're a licensed business and needed a license and they did a job in Texas, but they're based in Arizona. So, they know that that was their mistake. So that might be something that we might specifically carve a specific indemnification around that's not subject to the same usual expiration dates for indemnification obligations. So with due diligence, we're asking a lot of questions. Our due diligence request list is about 14 pages. Our chart that we review with all the due diligence materials that we provide our clients with the material issues that we see is significant. And we go through every single document that's provided to review it for issues. And we talk through, well, here's where we need additional information. Here's how we can influence the transaction documents to best support you. So due diligence is really a dance. It is getting to know your other partner. It is setting you up for success. It's helping you make informed decisions about risk allocation and risk determination and whether it's a risk that you are comfortable with or it's a risk that you're not comfortable with. But really, as attorneys, we are not killing deals through due diligence. We are advising you as to the risks, how to mitigate them, and how to ascertain their consequences and what those may be, and then giving you the power as the buyer to determine whether it's a risk that's acceptable to you because you're getting a good price for the deal or whatnot. And you get to make the decision whether it's the right risk for you or it's the right deal for you. We do recommend that you sequentially go through due diligence. If you are cost sensitive, you allocate enough time to do your own operational due diligence for pre-LOI and immediately post-LOI. We do get engaged usually pre-LOI or immediately after an LOI is signed because there's a lot that we have to get you up to speed on, send you the due diligence request list so that they can populate the data room while you're doing your operational due diligence. And then pretty shortly after, you should be getting into financial due diligence and then legal due diligence. And you should be going through your underwriting with the loan officers and your lenders and everything, going through your solicitation and finding your crew for investors if you're getting them all during this period, so that by the time that you're investing in legal due diligence, you will have gone through a number of your own gatekeeping items. But due diligence is incredibly important. And if you leave legal due diligence to too late, you actually end up losing a lot of the benefit of it as a gatekeeping item, because by then, if you've waited so long that at that point the seller's demanding the purchase agreement, you're like, okay, go through due diligence, start drafting the purchase agreement, do all the things. Well, first of all, to draft the purchase agreement and ancillary transaction documents, we have to do due diligence because it will materially influence what those terms should be and what we need to address. And also, then you can't use due diligence, which is considerably less expensive than negotiating a purchase agreement and ancillary transaction documents, as a gatekeeper to save you in expenses. Now, I will say, while your attorneys are not your deal killers, they're really your advisors to help you make informed decisions. It is really important to engage them at the right time so that everybody can prepare the data room. That can take weeks for the seller to do while you're doing that financial due diligence, and that you give your attorney enough time to be able to adequately represent you through the due diligence phase, because they can only do their job to the extent that you enable them to do their job for you. So making sure that you are not only working in your best interest as you're going through the transaction process, but also setting your attorney up for success to support you through the transaction process by engaging them at the right time, getting them involved early on so that they can help you do these gatekeeping analysis of this transaction to make sure that it's the right deal for you. And then I also have to say, one of the biggest deal killers that I've seen is lack of traction from buyers and moving so slowly and taking their entire 90-day period or whatnot to do due diligence. I have seen it on the sell side happen again and again. The seller expects to move forward quickly, and if you communicate a certain timeline, dawdling through due diligence will actually kill the deal for lack of confidence that the seller is going to have in you. And it's very difficult to get a seller to agree to extend a exclusivity time period after it has already lapsed when you haven't shown that you've used that period judiciously. So I actually have seen a lot of deals die in due diligence, not because of any findings, but simply because the buyer didn't use that time appropriately. And that does kill a lot of deals. And it also kills a lot of confidence of sellers. Having represented many, many, many sellers, it really kills their confidence that you're going to be able to finance the deal, that you're going to be able to close the deal, that you have investors supporting you, and that you're not just making up excuses to draw out the timeline for all of those things. It costs a seller a lot of money to go through the due diligence process because they should generally have an attorney on board that's assisting them with that process. And they likely also have other providers that are supporting them through that process too. So I realize that a lot of times buyers sit in their own seat of, I need to do this due diligence. I need to figure out and make sure that it's the right deal all the way along, and then take the time I need. And you should take the time you need, but you also have to communicate accurate timelines to the seller, and you actually have to make really significant progress throughout that exclusivity period, which is why I say that due diligence should only take 30% of it. Because if a seller has been spending weeks providing every detail of their business to you as the buyer, and you're not doing your job by getting the ball rolling and getting transaction documents and talking about material deal terms and everything like that, you really lose a tremendous amount of momentum in the transaction. Momentum is something that you have to really continue to cultivate. That's something that we really focus on as your legal counsel. We like to have weekly meetings. We like to send you updates. We like to tell you what's coming, what we need to do next, keep you on track. At the very beginning, as soon as we get an engagement, we not only prepare the due diligence request list, but we also prepare the closing checklist and timeline so that you can see when things should be phased, so that it doesn't just die in due diligence merely because of lack of momentum. And we also prepare a material deal terms list so that you can start having those hard conversations up front, because not only is due diligence a gating item and deal breaker, but also you have to talk through the material deal terms. That's why we provide those, so that you guys can start having those hard conversations financially, because financial aspects, not just financial due diligence, but financial aspects such as working capital, purchase price allocation, rent if the seller owns the real estate, all of these can be deal breakers for the parties. Now, I think there's a lot of creative ways to negotiate that they don't have to be deal breakers. But let's face it, if there's an economic value that the seller expects in the transaction on the whole, between their payment as an employee or an independent contractor or consultant, plus the seller note, plus lease payments, plus the purchase price payment, if they're not getting out of it what they want to sell the business, the deal's not going to go through. And so you don't want to be having us prepare a purchase agreement and say, oh, we'll fill in the information about the working capital so far down the line. Yes, we can, but you're really leaving some big items that are material deal terms and potentially deal breakers on the table too late. That's why we set our clients up for success with those key fundamental aspects to support them in that early gatekeeping time of the transaction. That gatekeeping time is all about discovering issues, doing due diligence, and also maintaining momentum so that you can get to the rest of the transaction, so that you can get to the purchase agreement, so you can get to the ancillary transactions, and so that you can get to closing. So it is a dance in many different ways. You have to know your partner, you have to assess them, but it's a two-way street. They're going to be doing due diligence on you too, and they're going to be assessing whether you're actually the right person to buy this business. Are you taking this seriously? Are you putting in the time? Are you able to close the deal? Those are all things that the seller is doing in due diligence too. I hope that this episode has been helpful walking through the deal breakers in due diligence and the deal breakers in a deal. I hope that it has helped you see that the lawyer isn't the one that kills the deal. They should be helping you decide whether it's the right deal for you. And always remember, it's better to spend a couple $1,000s doing the due diligence you need than a couple $1 million buying a business that is not the right business. With that said, it is really the minority of deals that we see fall through by the time it gets to legal due diligence, because financial due diligence and operational due diligence are generally your gatekeepers. Oh my gosh, I forgot one more major thing that I did cover in my prior episode on due diligence, but make sure you know who the sellers are. Make sure you know who owns the business, because you can't legally transfer the business if you don't know who owns the business. But I did cover that in the last episode, and I did say you really should check out that episode if you haven't checked it out already, because it really goes over the fundamentals. Here we're talking mostly about all the deal breakers. I hope you join us for our next episode of the Dealmaking with Laura DiFrancesco podcast. Please be sure to subscribe, share it with your friends, tag us on social media. If you'd like to work with us at Dean Street Law, you can apply to work with us on our website. All the information is down in the show notes. And of course, if you need additional resources such as Acquisition Insights, it's your course for buying a small business. And I'm so excited. I have a little bit of exciting news coming out soon. My book is about to be published, all about the legal aspects of buying a business. We're also going to be doing the same things, courses on sell side, books on sell side, all of that as well. So be sure to stay tuned for more. Thank you so much, and happy deal making.